Hello again from me, Kevin French at Core Wealth. We are well into 2026 and we are going to be having a look at what happened for the first month of this year. So the year started off well. We saw global equities around the world up on average 2.2% for the month of January. But if we have a look underneath that top line number, we see that there were quite a few rotations happening. First of all, value outperformed growth quite considerably. And this was on the back of the US earnings season coming out and a number of the technology stocks actually coming out with cautionary notices, or the market wasn't happy with their performance. For example, Microsoft and Netflix were both down 11% for the month. Apple was down around 5%. Meta, or the old Facebook, was up quite nicely during the month. So a number of things happening as the market was sort of digesting both the historical news and looking ahead at what those companies are going to be investing to prepare themselves for AI. Some of the underlying themes that also happened during the month was the uptick in the energy sector. This was on the back of the crude oil price going up quite strongly, closer to $70 a barrel, and that driving some of the oil producers. The uptick in emerging market was driven predominantly from two sectors, one being the semiconductor producers in countries like Korea and Taiwan. Emerging markets that have exposure to the mining sectors, particularly gold and platinum, also did very well during the month as those prices went up quite strongly. In addition to that, we saw global bond markets coming off and the US bonds actually reducing in value during the month. And on the back of some geopolitical tensions between the US and Europe, particularly around Greenland, we saw that the US dollar weakened further during the month to its lowest level in some 4 years now. The Johannesburg Stock Exchange had a really strong start to the year and was up 3.7%. It's now up over 70% for the last 2 years. If we have a look at where that came from, a lot of it was driven by the mining and resource companies, particularly those with platinum and gold in their stables. In addition, we saw a number of the banks and financial companies doing very well during the month. Now, at the end of the month, there was a pullback during the last 2 days, and this was as we saw the gold and silver prices coming off quite significantly, as well as Bitcoin. Even with that, we saw a strong run for the month of January. We also saw the South African bond market improve, and we also saw the rand strengthen significantly against the dollar. At one point, it was close to 15 Rand 50 to the dollar and ended around 16.15 against the US dollar. But even with that, was stronger over the month. So let's have a look at how the markets did individually, both over the month of January and looking at some longer periods of time as well. And here you can see the standout right at the top is that developed markets had a good month. They were up 2.2%, but emerging markets were up almost 9% for the month. We still saw strong markets in Japan and Europe and the UK as well. I want to just draw your attention to the 1 year number that we're showing here. And you can see if we look at global developed world equities over the last year were up some 19.6%. Remember, the US makes up the bulk of that figure. Emerging markets, however, were up nearly 43% over the last year. And we see again areas like Japan, Europe, and UK and China doing really well compared to the US, which had a good year, was still up 16.3%, but all those other areas actually outperforming. This next slide, we're going to have a look at the South African markets and how they have performed over the various periods. You can see from this slide that the South African equity market, as we said earlier, was up 3.7% for the month, which is exceptional, and over the last year up over 44%. Listed property not far behind that over the last year, and South African bonds giving you 26.1% over the last year, which is really incredible. The US dollar and the pound and the euro all weaker against the rand for last year, and the rand is some 14% stronger than the dollar over the last year. If we have a look at the 10-year number now on the South African equity markets, 13.1%. If we take the fact that the rand against the dollar is basically flat or 0.1% weaker over the last 10 years, and if we looked at developed world equities, they gave a return of 13.1% as well. So over the last 10 years now, the South African equity market has actually kept pace with global developed world equities. So it's almost the end of the tax year, and you would have probably been contacted already to have a look at whether you have maximized your tax deductions you can make in terms of retirement annuity contributions, and also the contributions you can make to a tax-free savings account investment. The model we're going to talk about today is our long-term growth tax-free savings account investment. We started running this portfolio almost 11 years ago now, in May 2015. It's targeting inflation +8, and it aims to have a high exposure to growth assets. And growth assets essentially are shares or equities and listed property. It includes some offshore exposure as well. Just looking at this graph shows you the benefit of investing in something that gives you that extra growth. If you'd have put 100 Rand into this portfolio just over 10 years ago when we started it, it would now have grown almost 2.5 times to 240 Rand. That's a lot stronger than if you'd have put it in cash. A number of the banks advertise that you should use your tax-free savings account to put cash into them. But actually, if you're going to hold things for the longer term, it's much better to allocate tax-free savings accounts to a more growthy type investment, especially if you're doing something like this for your children or your grandchildren, for example. So if you have a look at that graph, looking at the green line, you see that the green line would have grown from 100 Rand to 190 Rand. Compared to what you would get if you were in this growth portfolio, instead of getting 190 Rand, you would have got 240 Rand. Now, if you take that over a long period of time, that incremental growth really will make a significant difference. And then at the end, there will be no tax that will be applied to it. So we're going to have a look at one of the managers inside our tax-free savings long-term growth strategy, and that is the Truffle General Equity Fund. And we can see here just its performance over time, significantly outperforming the peer group, which is the gray line on this graph. If we have a look at its top 3 holdings, one is Naspers, the media and essentially software company, which owns a big stake in Tencent, Goldfields, which is a gold mining company, and FirstRand, which is a bank. And you can see the weights that they are in its portfolio, and then the returns over the last year, which have all been quite strong, but especially the gold mining company, Goldfields, is up over 170%. The next slide just has a look at the underlying asset classes. So are we invested in shares or cash or bonds, offshore shares? And this is what this graph shows, the purple lines or bars being the fund itself, the long-term growth strategy, and then the gray bars showing the flexible peer group. So the rest of the class essentially that's also quite aggressive. And we can see here that if you look to the far right, that in terms of growth assets, which is essentially local and foreign equity plus local and foreign property, almost 97% of this portfolio is invested purposefully in those type of growth assets. And that will give you the extra outperformance over the long term. We're going to unpack why we have an overweight in emerging markets and what our view is around some of the attractiveness of that space. In this first slide, you'll see that we've got 2 graphs. The one on the left just shows the spot price of industrial metals. And we can see this goes back to the early 80s. But we can see in around 2020, that index was as low as 630. It's now up at over 1,300. So considerably stronger over the last 5-6 years now. On the right, we can see that same industrial index in blue, but the red lines just showing emerging markets. And we can see quite a high correlation. So as industrial metals prices go up, we also see emerging markets go up. Over the next couple of slides, we're going to have a look at what is going to support the price of those industrial metals over the coming years. So there's some big changes happening around the world, and some of these are going to continue to support the price of industrial metals. The first one is spending on defense. What we have on the left here is just showing how different countries have changed their pledge to spend more on defense. NATO is wanting its members to spend around 5% of GDP on defense spending, but you can see all of those countries now between 2 and 4.5% is being spent on defense spending. The graph on the right just shows you how different exchange traded funds have reacted to this commitment to spend more on defense. And we can see that the aerospace and defense type ETFs have all seen some good demand and their prices going up over the last couple of years. This further underpins the demand for the industrial metals that come from your emerging markets. The other structural driver that's going to underpin the demand for industrial metals is the capex, or the capital expenditure that is needed and being done for artificial intelligence. What we have on the graph on the left just shows you the capex of all the artificial intelligence hyperscalers, as they're called, all the big companies. You can see their names there: Alphabet, Amazon, Meta, Microsoft, and Oracle. And in 2024 combined, they all spent $241 billion on their capex towards artificial intelligence. That is going to go up over the coming years to projected to be around $640 billion per year. To put that in context, the Apollo space mission, which ran for over 11 years, only spent $178 billion compared to the $640 billion that's going to be spent per year. Much of that investment is going to go into products that will require industrial metals from emerging markets around the world. On the graph on the left of this slide, we can see the different emerging markets and how they performed for the first 3 weeks of 2026. And you can see very different returns from different countries. And that's because a country like South Korea has high exposure to companies that make semiconductors, while a country like Brazil has high exposure to energy. A country like South Africa has high exposure to precious metals and industrial metals. What is needed by investment managers is to be able to decide which emerging market to invest into, and that will be a key driver of investment performance going forward. We spoke about a change in the allocation of investments around the world, and this graph shows it quite interestingly. Where the graph is going up, we are basically saying that stay-at-home industries in the US, so more investments into America itself, are predominant. Whereas when the graph turns downwards, that is when American investors are starting to invest outside or globally. And we've seen a very long period of time and an extreme increase from levels of around 4 to around 16, where investors were very focused on the US. And we think that we're starting to see that turn now, where we expect investors to start focusing their attention more globally than locally, as they have over the last number of years. As the dollar weakens, emerging markets tend to do well. As the dollar strengthens, it usually puts a bit of a handbrake on emerging market returns. And what we're seeing at the moment is a period where the dollar is in fact weakening, and that is the blue line that we're showing over there. And as the blue line turns down, we can see that the emerging market indices have started to pick up. We still think that there's further weakness to come from the US dollar over the coming years. And on the back of that, we expect that to become a tailwind for emerging markets. We're going to close off with some valuation analysis. These two slides are some that we've shown before. The one on the left just shows us how the different regions look in terms of their price-earnings ratios. The higher a price-earnings ratio, the more expensive that market is considered to be. And we can see at the moment, the US market, for example, is trading at over 22 times its price-earnings ratio. Compare that to the emerging markets, which are below 14 times, so almost a third cheaper than the US equity markets. And that is something that we think enables us to buy in at still reasonable price levels, despite the strong returns we've seen over the last 2 years. So our last slide is just saying, if we look forward, we take all these things into consideration. If we look ahead for the next 10 years, what return above inflation in US dollars do we expect from different countries? And what you can see on this graph here, the one on the far left, we actually need to be looking at the yellow dot. The yellow dot says Brazil, for example, its expected returns over the next 10 years in US dollars above inflation are 10.6%. So really strong real returns there. Compare that to the US large cap companies, so big companies on the US stock market. The expected return, the yellow dot there, above inflation is only 0.6%, so significantly lower. And you can pull out a number of other emerging markets, RAFI, which is a more valuation driven, 8.6%, South Korea 6.3%, China 5.4%, South Africa 4.1%. So this shows us that there are significant opportunities around the world, whether that be in Brazil or whether it be in South Korea, whether it be in South Africa, to actually get good companies with good prospective returns into a portfolio. Thanks very much for watching. I trust this has given you some insight into our thinking and some of the opportunities globally. If you have any questions, please feel free to get hold of your financial advisor or drop a comment in the section below. We'd love to hear from you.